Cash is drying up, panic is setting in, and the banking elites just made a major policy mistake. I'm your host, Steve Van Metre, and American households are facing a major crisis. And as you're about to see, the latest move by the banking elites is only going to make it worse. Plus, my CTA strategy just nailed the trade on Brazilian equities, and my subscribers are up over 8%. If you want to make big money trading these markets, stay tuned to the end of the show to learn how you too can beat the machines and win. Now, let's head over to the Federal Reserve, where you're about to see one of the biggest policy mistakes in central bank history, as recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level. Now, historically, that's true, but stabilized is a big question, and the labor market conditions remain solid. Inflation remains somewhat elevated. This according to the latest FOMC statement. Now, we know that the unemployment rate historically is relatively low, but the trend has been rising, and that's one of the issues. But it's the labor market. They point to strength in the labor market, and there's a lot more to come on this, because what you're seeing in real time, my friends, is one of the biggest mistakes in central bank history, because they noted that uncertainty around the economic outlook has increased. And if you're wondering what the Fed is going to do about this, because yes, this is everything to do with the tariffs, as Fed Chair Powell said, well, the answer from the Fed is we're going to do nothing. The committee decided to maintain its target range for the federal funds rate at 4.25% to 4.5%. But beginning in April, the committee will slow the pace of its decline into securities holding by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. That's a slowdown in the pace of what's called quantitative tightening, but they're going to continue to unwind their mortgage-backed securities. That's going to stay at the same pace at $35 billion. So in response to economic uncertainty, now keep in mind, the Fed's job is to be forward-looking, to understand what's about to hit the economy and react. This time, the reaction is to do absolutely nothing. And as American households are facing a crisis where they're running out of cash, the Fed's making a major mistake. Let's take a look at the details here. And based on the committee's latest projection for the unemployment rate, they see it rising to 4.4% by year end, and then cooling off to 4.3% over the two following years. And what they're trying to say here is they believe that more Americans are going to lose their job. And when you look at the state of the labor market, particularly as we look at continued claims, we see little to no opportunity for a bulk of these workers to re-enter the workforce. And yet the Fed completely agrees with that. And this is completely baffling, because their response to this is that they're going to do nothing. Now, I, for one, do not think the economy can continue humming along without all of these workers. Now, if you agree with me, hit the like button. Weigh in the comment. Love to know what you think, because when asked what the Fed was going to do about policy, well, their projections were that the funds rate would be around 3.9% by year end, suggesting 2, maybe 3 cuts by the end of the year. And again, when you talk about the Fed, they're a forward-looking agency. At least that's what they project to the public, that they look out at where the economy is going and then they make policy around it. But when asked about the tariffs, they said, well, we're going to do nothing. When asked about the labor market, because yes, we see in the news there are companies laying off, the Fed acknowledged that. They said, yes, we do see that happening. We see the unemployment rate rising, but did you see the non-farm payroll report? It's showing there's jobs created, and we believe that along with the fact that people are seeing their wage growth increase, that the economy is strong and robust here. But the reality is that they foresee that things could get worse, and that's a big problem, because the Trump administration has done little to ease recession fears, with the president saying on March 9th that the U.S. economy faces a, quote, period of transition, and this backed by Treasury Secretary Scott Bessent, who said that the U.S. economy and financial markets were in need of a detox, meaning that the equity markets are likely to come down, meaning people are likely to lose their job. And the response here from the Fed, once again, is yes, we see all those things happening, and our answer is we're going to do nothing because we think the economy is strong enough as it is. Now, again, I disagree with that view. If you follow my line of logic, hit the like button, weigh in the comment, because when you start to look at the real risk facing American households, well, they're running out of cash. And in the response, the Fed should be cutting rates here. But again, they're not. setting us up for one of the biggest policy mistakes in history, as you're about to see. As Americans see growing risks that they're getting turned down for loans, and this is a major problem in a debt-based economy because new money is created when people borrow from commercial banks and that money gets injected into the economy where it's spread around. Now, if you think about it from a consumption standpoint, Americans love to borrow money they don't have to buy things they don't need, and that powers the U.S. economy, it powers the global economy, and it creates jobs. So when you start to see headlines that people are getting rejected for loans, well, it tells you there's one big problem with the economy, and that is people are running out of money. And in a debt-based economy, that doesn't lead to what the Fed says as a strong and robust labor market that can absorb, of course, all the changes coming from tariffs. What it suggests is we're headed right into a stagflationary recession. And the share of discouraged borrowers, defined as respondents who said they needed credit but didn't apply because they didn't expect to get approved, climbed to 8.5% according to the New York Fed's latest survey of consumer expectations. That's the highest level since the study began in 2013. So the question is, why do people need money? It's because the economy is slowing down, and that's a big problem because when people start to get their hours cut or maybe even worry about losing their job and being on unemployment for a bit, the one thing they need to do is get access to money to get through these difficult periods. That transition period that President Trump said was coming, the detox period the Treasury Secretary Bessent said we're facing. The problem is the banks don't want to lend, and this is a big challenge because the banks look at their ability to get the money back, and if someone doesn't have a job or they're not getting enough hours, the banks get nervous, and this is a problem because, again, if people start cutting back, if they can't access credit to spend, well, it tells us the economy is headed the wrong way. But something that should be headed higher, that's your trading account, because earlier this month we told our CTA subscribers to buy Brazilian equities on the open at this red candlestick, and yes, we noticed that momentum was rising. We noticed the trend was rising, but we also noted that machines were likely to be buyers here. Sure enough, they did. You see it broke through its 6-month volume profile, and today, after the Fed meeting, it's headed higher. If you want to learn how to trade against the machines and win, stay tuned to the end of the show. We're going to show you how to buy ahead of them and sell before they do and put big money in your pockets. Grab the links in the description below. Be sure to use that coupon code for a free 30-day free trial, because when you look at what goes on in the economy, when you talk about American households facing a crisis, it's one that they're running out of money. And you think about it, the economy's not creating enough money here. So what should the Fed be doing? What should their policy response be? To lower interest rates. Why do we need to do that? To spur the economy, to create growth, to create money in the system. And yet they're not doing that. So when we look at the data, what do we find out? That the delinquency rate on credit card loans is rising. We see that in red. Now, Treasury Secretary Bessent said he sees great credit card data, but we don't see that at all because we can note going back to 2021 that the delinquency rate was rising. Now, when we look at the data here from 94 to the 96, what do we see? The reason there was an increase in delinquency rate is because the labor market had an issue. You see continued claims bottom out and started to head higher. The system was running out of money. Households couldn't pay their bills. And look what happened going into the dot-com bubble. You see, once again, continued claims start to rise. Delinquency rate goes with it. You can see it happens again in 2006 with continued claims leading the way, driving the delinquency rate higher. And here we can see from the Fed saying the unemployment rate is going to go up to 4.4%. That means more households are going to be cash strapped. That means the delinquency rate is going to go up. And what's going to happen is more people are going to need money and find out the banks will not lend it to them. Again, the response here, it makes perfect sense that the Fed should be cutting rates, because if households are strapped for cash, what does it mean? That their debt service costs are too high. And how do you fix that if you're a policy administrator? If you're one of the banking elites that has control over interest rates, well, you should be lowering them, not leaving them where they're at. And the perceived likelihood of being rejected increased across different forms of credit, from cards to secured loans to buy homes and cars. Roughly 1/3 of all loan applicants expected to get turned down, the highest share since the start of the series, while nearly half the response in February survey said it would be harder to get credit in a year's time. So what are we seeing in the automobile industry? We're seeing inventory levels rise as manufacturers are building like crazy ahead of the tariffs, and what's happening is vehicles are stacking up on dealer lots. And when that happens, well, it's going to backflow through the supply chain and lead to layoffs at the manufacturing sector. So once again, what could the Fed do? They could cut rates. They could try to stimulate the economy here to get people to borrow and spend. But what's happening now is you see there in the data, what did consumers say? That they think it's going to get worse, meaning their ability to get credit is only going to get harder. And what they're trying to tell us very clearly is they think the labor market and the economy is going to get worse, not as good as the Fed projects. And here we can see why the banks don't want to lend as well, because they are worried they're not going to get their money back. As we look at the net percentage of domestic banks tightening standards for credit card loans, this shown in blue against the delinquency rate in red. Now, if you're behind on credit, well, what's one easy way to fix it? Go get credit somewhere else and pay off that loan, or use that credit to make the payments. You get through the difficult times, you find another job, maybe you pick up some more hours, and then you can get everything straightened out. That's how the system is kind of designed to work. But look what happens. The banks start to figure out there's something wrong in the economy, as they did back in 2000. They tightened lending standards, as you're seeing right now. And what's happening? People are saying, look, I need credit, I can't get it. And because I'm running out of money, well, I'm going into delinquency. That's exactly what happens in 2007. The banks rapidly tighten standards, they cut people off, and they drive the economy right into a recession. And that's what I want you to understand here, is this is a feedback loop. So as the economy slows and the labor market unwinds, the banks get nervous about getting their money back. So they constrict the creation of credit. They start telling people no. And then as people run out of money and need credit to bridge through the difficult time, they can't get it. So what happens? They start to go into delinquency, then they go into default. Then we have a financial crisis. Of course, then the government steps in and bails everyone out, as the Fed, with a late reaction, starts to slash rates. And look where we're at now. You can see banks have been on net tightening standards since 2022. You can see that's helped the delinquency rate rise. And while fewer banks have tightened standards over the last year, it still hasn't prevented the economy from running out of money. And the data adds to a picture of increasingly fragile household finances for many Americans, as a cooling job market slows wage gains while high borrowing costs are making bills harder to pay. And yet the Fed says this isn't a problem, because you should see the non-farm payroll report. It tells us there's jobs being created. And yes, we think more people are going to be out of work, but it's going to be okay. And yet the average American household is saying, look, that's not the case at all here. We're struggling, and in a big way. So if you think about, from the Fed's perspective, what could you do to take some pressure off the average American household? Give them a chance to afford higher prices that are coming from the inflation expected by the tariffs. To maybe get through this difficult time, you could cut interest rates, perhaps create some sort of stimulus into the economy that maybe would drive spending, maybe help keep some jobs, maybe drive up the number of hours worked. But nope, instead, they're going to do nothing. Delinquency rates remain low by pre-pandemic standards, and that's what the political elites see here. But what they don't get is they've been edging higher in most categories, and lenders are turning cautious, and what we're seeing is more American households running out of money. And it all makes perfect sense, because when we take a look at the average amount of weekly hours workers are getting, it goes right in line with the delinquency rate. Let's go back to 1994, where average weekly hours are on the decline. What that means for workers is their paychecks are shrinking as they can't afford higher consumer prices and all their bills. They go right into delinquency. You can see that happens in late 1999. Once again, a small drop in hours worked leads to an increase in the delinquency rate. And of course, that happens again going into the global financial crisis, starts to happen going into the pandemic. And look now, you can see perfectly in sync. Late 2021 is the delinquency rates rising. Why is that happening? Because hours worked are going down. And what did we hear from the latest New York Fed manufacturing survey? They cut hours. And we're hearing that more and more across the board, that companies are cutting hours. Many of you weighed in the comments and said, yes, I'm seeing my hours get cut as well. Want to know again what your perspective is here. Do you think the Fed should be cutting now to try to take some pressure off the finances for Americans, or should they stand pat where rates are at now? Weigh in the comments. More than 4 in 10 U.S. homeowners who sought to refinance their mortgages had their applications rejected, quadruple the share in October of 2023. And you can go back to 2022 and look what happened. You can see the trend rising here. And why are people looking to their house? Because they have equity. Can't get a credit card loan? No problem. Can't get an auto loan? No problem. Can I have some equity out of my house? Answer is no, you can't, according to the banks. But that's why people are looking to refinance, because they need money. And their house is one of the last places they see they can get it. And what did we see today? The Mortgage Bankers Association reported their refinancing gauge declined nearly 13%. But that was after reaching the highest level since early October in the previous week. Again, everybody looking for money with the equity in their home as the last possible place to get it. The problem is banks are saying not a chance, you can't have it. And here you can see something that would be a big benefit to American households as we look at the commercial bank interest rate on credit cards in blue against the federal funds rate in red. And what you can see is right now, cardholders are paying somewhere between 20 to 21%. Not the highest level in history, but pretty close to it. And what would happen if the Fed cuts rates? Well, it would bring that rate down. It would free up some cash flow. It would give households a little bit of breathing room. Would it solve all the problems? Most likely not, but it certainly would help and provide some much needed cash to help against inflation, to help pay bills. And what we can see based on American households' finances, based on the delinquency rate rising, that's only going to get worse. Now, at some point, we would expect the Fed to cut, but there's a problem. It's not going to work. And I'm going to show you why. Let's first turn to China, where they're cutting rates and trying to get people to borrow as consumer loan rates now hit a record low to spur demand. The problem is it's not quite working out. Let's take a look at some U.S. data here, because what I want you to see in the commercial industrial lending data is we're sitting on a 1.2% year-over-year rate of change in commercial lending growth. Now, one of the problems here is if you want to create money in the economy, to get enough money out there, you have to have the commercial banks originating new loans. That's how money is created in the economy. Now, the question is, how much do they need to create to spur economic growth? Well, if we go back and look historically during expansions, 2000s, and even the last cycle, you need to see about 10% year-over-year growth. Where are we at now? 1.2%, not enough. The record low rates are a reflection of fierce competition among banks amid low consumer demand. And that's really the issue here, is when demand for lending goes down, rates need to fall. And that's what the Fed can't see. And why, one, do you see the commercial data here? Because we need to see commercial lending at a much higher rate to create money in the economy, to get money moving around it so people can pay their bills, so they can create consumption, so they can drive the economy and the labor market. But at 1.2%, what is that telling us? That rates here in the U.S. are too high. Again, Fed's response, we're going to do nothing. But the root lies in people's weak expectations for income growth and economic outlook. Cheap loans might help lift consumption to an extent, but banks need to be vigilant on risk control to avoid an increase in bad loans. So even in China, they recognize, look, the economy's slowing and we can cut rates and lend to people, but then that means that banks are going to get stuck with a lot of bad loans as people go back into delinquency and eventually default, necessitating a massive bank bailout. It's going to happen all over the world. So if you want to know why the Fed's making such a huge policy mistake, why cutting rates in China isn't working, why it won't work here, there's one very simple reason, my friends, is because when people don't have a job, they can't borrow money. Here you can see the unemployment rate rising as the Fed's cutting rates in blue, drives us right into recession, and it makes perfect sense. You can cut rates all you want, but if people don't have a job and banks don't want to lend, it makes no difference. Again, you talk about my case of why we think rates are headed back to zero. You can only look at the fact that while the Fed sees the unemployment rate rising to 4.4, my bet is if it gets to that level, it's going to go a whole lot higher. But something else that should be going higher, that's your trading account. Let's take a look at that trade on Brazilian equities. We see it's now up 8.14% and headed higher at the time of filming after the FOMC meeting. And this was really simple. We just told our subscribers to buy it open on the 10th. Now, how do we do this? Well, we look at machine positioning across the broad equity, bond, currency, and commodity markets, but our edge is we run a historical overlay. So we see when the machine should be buying ahead of when they're actually buying. And that flags on a report on our hot list, which has that embedded data of our backtest models built right into it. And the best part is what we look for is, again, that discrepancy. So we want to get our subscribers to buy before the machines have to, create a tailwind behind their purchase. Here's the best part. You get the daily report, you get all the signals from the report, but even if you don't look at it, I break down all the best trades. We make it very simple for you. We've integrated all the backtest data. We give you risk control levels, a full update on all of our open trades every week. Not to mention, I disclose how I'm trading the reports. Along with that, a free 30-day free trial. Why is that? Because we're so confident you can make money trading our reports that we want your first month to be on me. And with that, you want to check out those links in the description below. And again, be sure to use that coupon code for a free 30-day free trial. And again, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.